Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help POA students like you ace their exams. Today we have got a practice question which requires you to prepare the statement of financial performance, also known as the income statement, and the statement of financial position, which is also known as the balance sheet. This is a very important question for your exam, and our goal from today's lesson is to ensure that you are able to score full 20 out of 20 in the main exam in October. You can see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll go through and explain step by step. What I need you to do now is focus and follow through for an excellent understanding, because I can guarantee that this is the best lesson on income statement and balance sheet that you can get. With that being said, let's begin. The following balances were extracted from Jamie's business on 31st of May 2020. So here you can see that we are provided with a list of balances for many different types of accounts, and then we are provided with the additional information that is relevant to this business. And you know the requirement is to prepare the statement of financial performance and the statement of financial position at the year ended 31st of May 2020. So let's look into the first information that we have got. At 31st of May 2020, general expenses $2,600 were owing. So we understand that we are preparing the income statement and the balance sheet for the year ended 31st of May 2020. And at 31st of May 2020, we have got $2,600 of general expenses which were owing. This is also referred to as accrued general expenses of $2,600, which falls within the definition of a current liability, because this is an expense which we have incurred but we still have not paid for it using cash at the end of the year on 31st of May 2020. Therefore, this is a present obligation to us at 31st of May 2020, and therefore this falls within the definition of a current liability. All liabilities are recorded in the balance sheet, so when you prepare the current liabilities section in the statement of financial position, make sure to show the general expenses accrued or general expenses owing of $2,600. Now, what's the total general expenses which we will report in the income statement or the statement of financial performance? Now, if you carefully check the list of balances which we were given initially, you will find that general expenses is given to us at $15,600. But at the end of 31st of May 2020, based on additional information, we understand that we have got $2,600 more of general expenses accrued, which we have incurred and therefore need to record to find the total. Therefore, to calculate the total general expenses, you are just simply adding $15,600, which is the original amount based on the list given in the question, plus an additional $2,600 altogether, which gives us $18,200, and this is the amount for total general expense which we will report in the income statement. Now, why are we adding $2,600? This is mainly because of the accrual basis accounting theory, which says that expenses are to be recorded as incurred, not necessarily when cash is paid. Here we know that this amount is accrued and cash hasn't been paid, but this has been incurred in the financial year ending 31st of May 2020, and therefore is to be added with $15,600 to find the total general expenses of $18,200, which we will report in the income statement. All right. Now, let's move to the second additional information which we have got. The rent expense covers the period of 1 August 2019 to 31st of July 2020. We understand 1 August 2019 until 31st of July 2020 altogether have 12 months, and the rent expense amount which we can find from the list that was given to us is $14,400. Okay? Now, we understand that we are working with a business where the most recent financial period started on 1 June 2019 and ended on 31st of May 2020. The amount for rent expense of $14,400, which is given to us in the list, can be divided by 12 to find the monthly rent expense. So $14,400 divided by 12 gives us $1,200, which is the monthly rent expense. Now, from the 1st of August 2019 until the end of 31st of May 2020, which is the end of the financial year of the business that we're working with in this question, we have got 10 months in total. We have got August, September, October, November, and December. Then we have got January, February, March, April, and May. Altogether, we have got 10 months. Now, what is the total rent expense for this 10 months? It's $1,200 on a monthly basis, which we have calculated earlier, multiplied by 10 to make it 10 months altogether, and that is $12,000 of rent expense for 10 months for the year ended 31st of May 2020, which is the amount that we will report in the income statement or the statement of financial performance. Now, don't forget that we have got prepaid rent, which refers to rent payment made in advance for the months of June 2020 and July 2020. June and July 2020 are the months in the next financial year, starting 1 June 2020. Our business currently ends at 31st of May 2020. So anything after May 2020 is basically advance payment, and the advance payment in this case is for 2 months of June and July 2020. We know rent on a monthly basis is $1,200. Therefore, the advance payment or the prepaid rent we have made for 2 months is $1,200 multiplied by 2, which is $2,400. And this is the amount that we will report in the current asset, because this is clearly an economic benefit that we still have yet to consume, and we will use it in the next financial year, and thus we will report it in the balance sheet under the assets section. Okay? Now, let's look into the third additional information. Commission income is earned at $300 per month. Now, total commission income based on this information can therefore be derived at $300 per month multiplied by 12 months, which we get in a financial year altogether, which will give us $3,600 as the commission income earned, which we look forward to reporting as part of other income in the income statement. Now, if you check the balance for commission income that's given here, it's $2,800, all right? And based on our calculations, we understand it's supposed to be $3,600. This means that $800 of commission income, which is the difference between $3,600 and $2,800, is income that is receivable or we expect to get in the future. Therefore, some economic benefits are attached here, and we know that we will get some money in the future in the next financial year starting 1 June 2020. Therefore, this falls within the category or definition of a current asset, and all current assets are to be reported in the balance sheet or the statement of financial position. So when you prepare the balance sheet, you will show under current assets commission income receivable of $800, okay? And when you prepare the income statement, you will show $3,600 as the total income which you have earned under other income. Let's move to transaction number 4. A batch of inventory originally costing $9,500 was included in the inventory account. This could now only be sold for $7,800. Now, the rule is that inventory is to be valued at lower of cost and net realizable value. Net realizable value simply stands for the final selling price for this inventory. We know the cost of the inventory was $9,500, but now we can only sell this for $7,800. Therefore, the inventory value should be $7,800, which is the net realizable value that we have got now. Therefore, we understand that we have made some loss in terms of valuation, given that the inventory value dropped from $9,500 to $7,800. And what's the amount for that loss? It's simply the difference between $9,500 and $7,800, which is $1,700. This loss for inventory is what we will report as an expense. All losses by default are an expense, and this expense is to be reported in the income statement. Okay? Next, when you show the amount of inventory as a current asset in the balance sheet, because inventory is obviously a current asset because you can convert this inventory into cash in the future for your business, right? So the amount of current assets for inventory which we will report in the balance sheet is the revised amount that has accounted for the loss. Originally, the balance was $49,600, which is what you can see here. All right, on the left-hand side, I'm just ticking. And then you deduct $1,700 in loss, which gives us a balance of $47,900 for inventory. And that is the current asset amount for inventory, which we will show in the balance sheet. Now let's move to additional information number 5. Fixtures and fittings are to be depreciated over the useful life of 20 years. So this is basically the straight line method of depreciation, where we simply divide the cost of fixtures and fittings with 20. That gives us the depreciation on an annual basis. Now, what is the cost of fixtures and fittings? It's $200,000. Therefore, the depreciation of fixtures and fittings is $200,000, all right, divided by 20 years, which gives us $10,000 per year as the depreciation. And depreciation refers to the consumption of economic benefits that comes with an asset, or the loss in the value of a non-current asset over its useful life. Therefore, this $10,000 per year of depreciation for fixtures and fittings is what we can confidently classify as an expense. And as you know, all expenses are to be reported in the income statement. Now, what about the accumulated depreciation, which is what we report in the balance sheet as part of our net book value calculation for non-current assets? Accumulated depreciation at any given point in time simply stands for the total depreciation expense that we have got so far since the day of purchase. If you check the list of balances for accumulated depreciation for fixtures and fittings, it's $40,000. Now, in this current financial year ending 31st of May 2020, we have got an additional $10,000, which is added to the $40,000. Therefore, the accumulated depreciation becomes $50,000, and this is the amount which we look to report in the balance sheet. Okay? All right, let's move to point number 6. Motor vehicles are to be depreciated at 20% per annum using the reducing balance method. Now, under the reducing balance method, first of all, we want to calculate the net book value. The net book value is simply the difference between the cost and the accumulated depreciation. What is the cost? The cost for motor vehicles is given at $80,000, as you can see here, just about to highlight. Okay, and the accumulated depreciation for motor vehicles is $16,000. So on that basis, the net book value, which is the difference between the cost and accumulated depreciation, is $80,000 minus $16,000, and that is $64,000. Once we have derived the net book value, now we can find the depreciation. The depreciation for motor vehicles is basically the given percentage of 20 multiplied with the net book value of $64,000, which gives us $12,800 as the depreciation for motor vehicles. And depreciation is an expense, which we have discussed in the previous point, and this expense is to be reported in the income statement. What about the accumulated depreciation, which we'll report in the balance sheet? Previously, for motor vehicles, the accumulated depreciation was $16,000, all right? In this financial year ending 31st of May 2020, we have derived an additional $12,800, which gets added to $16,000. Altogether, that gives us $28,800 as the accumulated depreciation for motor vehicles, which we will report in the balance sheet. Let's look into point number 7. Trade receivable loan was declared bankrupt on 31st of May 2020. The amount owed of $1,200 is to be written off. This has not been recorded. So if we check the amount for total trade receivables, which we have been given, all right, so you will see that total trade receivables was $17,500, which you can see I'm highlighting in yellow in the question. Now, what's happening is that one of the trade receivables cannot pay, and therefore we have to write it off. And that amount is $1,200. So what we are doing here is subtracting $1,200 from the $17,500, which is given in the list. That leaves us with the final trade receivables balance of $16,300. Trade receivables refer to the credit customers of the business. These are the people to whom you have sold on credit, and these people owe you money. Therefore, they are current assets which we report in the balance sheet. Now, this $1,200 which we are writing off is a bad debt, which is referred to as an impairment loss, and this impairment loss is to be classified as an expense in the income statement. In fact, all losses are classified as an expense, so always remember that. Let's look into point number 8. The allowance for impairment of trade receivables is to be maintained at 5% of trade receivables. Now, the remaining trade receivables after the impairment loss was deducted was $16,300, okay? So if you want to find the new allowance for impairment of trade receivables at 31st of May 2020, you can find it by multiplying 5% with the remaining trade receivables of $16,300. That gives us an allowance of $815. And this is the amount which we report in the balance sheet. Okay? Now, there's one more thing here as well. If you check the allowance for impairment of trade receivables balance that we are provided in the list, it's $3,400. This is the amount which was at end of the previous financial year, 31 May 2019. In this financial year, our allowance has significantly gone down to $815 based on the calculations which we have done. So there is a decrease in allowance for impairment. And what's the amount of decrease? First of all, we know that we started with $3,400, which was the balance we had at end of 31st of May 2019, the previous financial year. Then we know this amount is going down because we have an impairment loss of $1,200. Okay? So when we have got an impairment loss of $1,200, it is going to further reduce the allowance for impairment that we originally have. What's the allowance for impairment standing for? The allowance for impairment is like a safety account where you know that this is the amount of credit customers who may not be able to pay. So this $3,400, which you originally had stored, now gets reduced by $1,200 because one of the customers has confirmed that they're unable to pay. And that's what you have written off, which will reduce your allowance by $1,200. That's why we are subtracting $1,200 from $3,400. Then, for the current financial year, ending 31st of May 2020, the new allowance is $815, which clearly indicates that the allowance for impairment has gone down. So that's why we are subtracting $815 from $3,400 again, and altogether the decrease in allowance for impairment is $1,385. And this is the amount which we will report in the income statement in our expenses section, but not really as an expense which we are subtracting, but rather as a benefit because it's a good thing that our allowance for impairment of trade receivables have gone down. So hold this thought for now, and when we prepare the income statement, I'll show you how to include this $1,385. Now let's look into point number 9. Dividends of 5 cents per share was declared on 29th of May 2020. The dividends will be paid on the 1st of September 2020. So when we are preparing the financial statements at 31st of May 2020, this is a dividend payable because it's a current liability, because we will only pay this dividend for cash on the 1st of September 2020, which is the next financial year. So because it's dividend which we owe to our shareholders, it is definitely a current liability that we will report in our balance sheet. Now, what's the amount of dividend? We know we are paying a dividend of 5 cents per share, which when represented in dollar terms can be shown as 0.05. All right? Because 5 cents is basically 5 divided by 100, which is $0.05. And it's 5 cents per share. If you check the question carefully, at the very beginning, you will see issued share capital of 100,000 shares. So that is why 5 cents is multiplied with 100,000 shares, and that gives us $5,000 as the dividend which we have to pay and record as a current liability in our balance sheet. Also, this $5,000 will be accounted for as part of our retained earnings calculation at 31st of May 2020 after we have calculated any profits or losses from the income statement. All right, so we will come back to this again. Now let's look into the preparation of the income statement or the statement of financial performance. I'm ignoring all the formalities here, such as the title and everything. You can do it yourself. So let's look into how we can prepare this income statement. So the format is the usual format which you're used to. We start with the sales revenue, and that is $88,500. And then we deduct sales returns of $3,500 from the sales revenue, which gives us a net sales revenue of $85,000. Now, what I recommend you do as you prepare this is to take the items which you have already utilized as part of your financial statements preparation, so that way you don't miss out on any item. So the sales revenue and the sales returns have already been used, so we are just taking them. Next, from the net sales revenue, you subtract the cost of goods sold. And the cost of goods sold is given to us in the list at $32,000. So we are taking that as well, right underneath the sales returns. So $32,200 subtracted from $85,000 gives us a gross profit of $52,800. Next, do not forget the other income, and that is the commission income. That is why I was emphasizing on the fact that you need to be very focused and have a sharp mind when you are solving a question like this, because if you are focused, you can definitely get full marks. So the other income in this case is the commission income for the 12 months, which was $300 per month multiplied by 12 months, that was $3,600. So gross profit plus other income, which is the commission income of $3,600, that we will add to gross profit. Next, we subtract all the expenses, starting with the general expenses, okay? All right, so let me just take the commission income for now. All right, so general expenses of $18,200, which is what we have calculated, including the additional information and the balance that we were given in the list. So we were given $15,600 originally, and then we have added $2,600 of accrued general expenses, which gave us a total general expenses of $18,200. Next, we have got the rent expense of $12,000. So let's take that as well. I apologize for that. So rent expense of $12,000. And this $12,000 is the rent expense, which is valid for 10 months, given that we derive $1,200 per month multiplied by 10 months, which are the months from 1st of August 2019 until 31st of May 2020. Okay? Then we have got wages and salaries of $31,100. We have no adjustments for wages and salaries, so we can just confidently record the amount that we are given here in the list. And then we are recording the impairment loss for inventory. The impairment loss for inventory of $1,700, if you recall, was calculated based on the information given in point number 4, where the cost of $9,500 had been reduced to $7,800. And that's the $1,700 of impairment loss, which we are recording here. Next, we had got depreciation of fixtures based on point number 5, which was $10,000. Followed by depreciation of motor vehicles based on point number 6, which is $12,800, derived using the reducing balance method. Now remember the decrease in impairment of allowance for trade receivables that also will eventually come back to. So because it's a decrease, it's a good thing, because now there's less possibility of our money to be not recovered, okay? And that is why this good thing is going to reduce the total expenses we have got before that. So that is why we are showing $1,385 as a negative. If this was an increase in impairment allowance for trade receivables, then it would have been a bad thing. And in that case, you would not have to include the brackets to reflect the fact that it is being deducted, but rather you would have added it. But in this case, it's a good thing because our allowance has significantly gone down from $3,400 to $815. Okay, now decrease in impairment allowance for trade receivables of $1,385 is being subtracted here. So once you do all these numbers here, you will see that you end up with $84,415 as the total expenses. All right, so our gross profit $52,800 added with commission income of $3,600 minus total expenses of $84,415 means we have actually made a loss of $28,015 because our income is significantly less than our total expenses. Okay, so $28,015 is the loss. Again, how did we get it? $52,800 plus $3,600. That would have given us, I believe, $56,400 or something. right? So 55,800, yeah. And then you subtract the total expenses of 84,415, which gives us a negative amount of 28,015. And because it's a negative amount, this is called a loss. So that's why loss for the year of 28,015. Okay? Yep. That's all for the income statement or the statement of financial performance. Now, let's look into the balance sheet. Again, you can include all the formalities here. Statement of financial position as at 31st of May 2020. You can include that when you prepare it. Now, so when we start preparing the balance sheet, we'll start with our assets. And assets can be categorized into non-current and current assets. Non-current assets refer to assets which we will use in our business for more than 1 year. And current assets refer to assets where economic benefits are expected to be received within 12 months. Now, starting with the non-current assets, we want to show this in 3 separate columns, which is the cost, the accumulated depreciation, which also stands for the total depreciation, and then the net book value. The net book value at any given point in time is simply the difference between the cost and the accumulated depreciation. So starting with the fixtures and fittings, which is the first non-current asset. The cost is $200,000, all right? And you will see that I'm about to highlight this in yellow. So $200,000 of fixtures and fittings at cost. And then the accumulated depreciation we have included here is $50,000 because originally we had $40K, and then for this financial year ending 31st of May 2020, we had an additional $10K or $10,000 altogether, which makes it $50,000. So net book value is the difference between the cost and the accumulated depreciation, which is $150,000. Okay. So as we have already utilized this, I believe it's best for us to tick this as well. Okay. Then we repeat the same thing for motor vehicles with a cost of $80,000, which we have picked from the list, and an accumulated depreciation of $28,800, which is basically $16,000 from before, plus an additional $12,800, which we have calculated using the reducing balance method. And the net book value here is $51,200, which is again the difference between the cost and the accumulated depreciation. So altogether, the total net book value for both non-current assets combined is $201,200. So let's just highlight all these non-current assets which we have already utilized from the list. So that way we know we have not left out any important information, okay? All right. Next is the current assets, obviously starting with the trade receivables. The trade receivables is $16,300. Why? Because originally we had $17,500, and then one of the guys confirmed that he's unable to pay, for which we have deducted $1,200, right? So that's why it's $16,300. And from our trade receivables, we always want to subtract the allowance for impairment of trade receivables that we have at the end of the financial year. The current financial year in this question, which is at end of 31st of May 2020, and that was 815, which was calculated, if you recall, based on 5% multiplied with 16,300, which was the revised trade receivables amount after the write-off was done. Okay? So the gross amount for trade receivables of 16,300 minus allowance for impairment of trade receivables for 31 May 2020, which is 815, gives us the net trade receivables of 15,485. So let's just tick this that we have already used. So trade receivables is fully done. Allowance is fully done as well. And then from the additional information, point number 7 and point number 8 is fully done because both of these points refer to trade receivables and allowance. Okay? So is point 5 and point 6 for depreciation. Now, the inventory is 47,900, which is the revised amount. In the list that we are given here, it's 49,600, right? And based on additional information number 4, we had to reduce this $49,600 by $1,700, which gives us a revised inventory amount of $47,900, which is obviously a current asset because we can sell this inventory within the next 12 months and convert it into cash, which is obviously an economic benefit that is attached to it. So inventory is already used. Therefore, we can just highlight this, that inventory is also done. Okay, so point number 4 is also done. So it's inventory. Next, we have got commission income receivable. If you recall, based on additional information number 3, $300 per month multiplied by 12 would have resulted in a total commission income earned of $3,600. But we actually received $2,800 so far based on the list here. Okay, I'm just going to highlight again. So based on the list here, that means $800 is receivable, which is economic benefit that we expect to get in the future, and therefore it falls within the definition of a current asset and is recorded under current assets. Okay, then we have got prepaid rent expense for 2 months for the month of June and July 2020, which is $1,200 per month multiplied by 2 months, that is $2,400. And prepaid rent expense, as you understand, is rent payment which we have made in advance. And at 31st of May 2020, this is a current asset because obviously there are economic benefits attached to it. And we will only consume these benefits when we start the next financial year. We don't have any other current assets. Normally you have the cash at bank account, but in this case we have a bank overdraft due to the fact that cash at bank is $2,700 credit. This means that we actually don't have any money in our bank account. Rather, we have withdrawn in excess. And that is why it's a bank overdraft, which is a current liability. And this amount of $2,700 is what you will report when you prepare the current liabilities section as bank overdraft. All right, so now we can find the total assets, which is the non-current assets of $201,200 added with the current asset of $66,585. That gives us total assets of $267,785. So this is what we look forward to achieve at the end of the statement of financial performance. Financial position. Now, let's look into the equity and liabilities section, starting with the shareholders' equity. Shareholders' equity is mainly because we have used issued share capital. So we are starting with the issued share capital of $150,000, which is the first line given in the list. And then we have got retained earnings of $27,485. This is the retained earnings at 31st of May 2020. And retained earnings simply refers to earnings that are available for reinvestment purposes. So how do we get this $27,485? All right. Now, so let's do the calculations. So retained earnings at 31st of May 2020 equals the opening balance of retained earnings of $60,500 from 1 June 2019, which is what you can see here. Okay. Then we would add any profits and we would deduct any losses. In our case, we have made a loss of $28,015. Okay, so that's what we will deduct. And then the dividend that we are paying of how much? Let's just look into our workings. $5,000 is going to further reduce the earnings available for investment in the next financial year. So therefore, we'll subtract $5,000 more. So once we do that, you should end up with $27,485, which is the amount that we have included here as part of our equity. Why is retained earnings part of our equity? Because this refers to the earnings that are available for reinvestment. And anything that is invested from the owner's perspective is classified as an equity. Okay, so $27,485 added to the issued share capital of $150,000 gives us total shareholders' equity of $177,485. Then we have got non-current liabilities and the current liabilities. The only non-current liability we have got here is the bank loan of $75,000. Okay, You can see I'm just highlighting in red, $75,000. So non-current liabilities are added here, $75,000. And then we have got current liabilities. So we start with the trade payables of $5,000, which is the amount you will see right underneath trade receivables, as you can see here. Then we have accrued general expenses from additional information 1, which is $2,600. So this is also done. Then we have got dividend payable from additional information number 9, and also what we have just looked into for our retained earnings calculation, which is 5 cents per share multiplied by 100,000 shares. That gives us $5,000 as the dividend payable. Then we have got bank overdraft of $2,700 because we have no money in the bank account. Rather, we have withdrawn in excess. And this is justified based on the credit balance that is given here, all right, for the cash at bank. So altogether, the total current liabilities come out to be $15,300. And it looks like we have utilized all the information that we get here in the list and the extra additional information. So the total current liabilities of $15,300 now gets added to the non-current liabilities of $75,000, which then gets added to the total shareholders' equity of $177,485, and altogether it's $267,785, which is the total equity and liabilities. That is 100% match with the total assets, and therefore you know that you have done your math correctly, given that you know you have included all the information, which is something you can justify by taking them as you use them, okay? And the balance sheet is entirely built upon the accounting equation, which is assets equal to equity plus liabilities. So the total of all assets must be equal to the total of all equity and liabilities. In other words, you can also say that all the assets in the business are either financed by you or financed by debt, which is the liability, okay? All right. So as you can see, this question needed a lot of my energy to speak and explain. My throat is parched, but I believe you have found value in this content. All right. Yep. It will be pretty easy for you to score full marks in the exam if you practice as many times as possible. All right. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel and share this channel with your friends, and check the link in the description to book a free Zoom call with me and discuss your coaching requirements to help you prepare for your exams in October. With that being said, I'll conclude today's lesson and I'll see you in the next one.